Hey everybody, Professor Wright here, hoping to give you something that you can learn, grow, and I'm here to teach you. So today we're going to be talking about something that is very interesting that came to me as I was teaching one of my classes. Now remember, I teach accounting at a college, and so while the students were asking me some questions and I was clarifying some things for them, this came to my mind as far as the difference between personal finance and business accounting. There's a huge difference. And as I look back at it and look at it or in reflection as well as now, I'm looking at it as personal finance does not allow you and does not teach you the structures to really generate personal wealth. So the Dave Ramseys, the Susie Ormans, they're talking personal finance, the elimination of debt, accelerate the elimination of debt, and things like that, when that's really out of context toward really building your business, which is you. Again, I'm a big values guy. What is it that's within you that's looking to be fulfilled? And unfortunately, it takes money to fulfill most of those things, if not all. So we're going to talk about some things today that are really clarifying. I hope they're clarifying at least to you, to allow you to structure this budgeting that I'm always talking about to you, to really structure it to where the budgeting isn't just done to kind of like manage your money, but it's done with the purpose of building personal wealth. Okay, so we're going to start off today with what is known as the accounting equation. Okay, and that goes like this. So that is assets equals liabilities plus owner's equity. Okay, so owner's equity is basically what you have vested inside of it. When you hear it on the news and the business programs, they're talking about capital. That's the business version of owner's equity. Okay, so here's something that's really interesting, and I'm gonna start off with this just to let you see some. Okay, so we're gonna go with there. Let's say you have $13,000 in the bank. You have $13,000 in your bank account. You owe $9,000 in, let's say, credit cards. Okay, just credit cards. I'm not going to put a house on it. I'm not going to put a car on it. I'm not going to put any secured assets on it. Just an unsecured credit card. You owe $9,000 in credit cards. Now, looking at this equation, 13 equals 9 plus what? 4. And if you've heard me talk about debt elimination and in my principle of timing, it's a big deal to know that your $13,000 is what you hold, that aggregate holdings that I'm always talking about. Then you have $9,000 in liabilities. If you were going to be a Dave Ramsey fan, he'd say accelerate and get that out of the way. Okay? And then you end up with your owner's equity. That's what you own overall. Okay? That's what this is. It's a real hard number to figure and identify because that's the way the equation works. But in real life, again, it's kind of hard to figure out. Okay, but overall, you have $13,000 in the bank, $9,000 in liabilities. So this is $4,000. It can be hard, but for me to simplify it, you have $13,000 in the bank, you owe $9,000, the remainder is $4,000. Okay, that's how this works. Let's look at it like this. Let's say you pay off the $9,000. So this number is 0. And you use it from the money in cash. What do you have now? Does anything change on your owner's equity? No. Does something change on your liabilities? Yes, you no longer have $9,000 in liabilities and credit card debt. But you also don't have the $9,000 in cash. Okay? So you've kind of like, I don't want to use the word compromise, but you've lowered your holdings position to eliminate the debt, but you've ended up in the same position. You still have $4,000 in equity. That's it. Nothing's changed. Okay? Did this allow you to do more things? Possibly. But would this allow you to do more things? Absolutely. Okay? So I'm going to throw something else to you. Now that you see that pulling from your assets to pay off liabilities does not necessarily increase your owner's equity. In fact, it does nothing to it. It's an equal equation. You can see that. Okay? Remember, I'm always talking about budgets. Okay? A budget is what is known as an income statement. So every month you have revenue, which is your paycheck, And you have expenses, which are your bills. Okay, this is the income statement. So if you go to Ford.com or GM.com and look at their financial statements, you're going to see an income statement for the time period. It could be for January, February, March, or it could be for all of 2017, all of 2018. Okay, that's your income statement. The income statement has to be done before you calculate this equation, which is essentially the balance sheet. In personal finance, this isn't known as owner's equity. In personal finance, this is known as net worth. Okay? Very, very challenging to identify and try to structure these things, which is why I'm trying to make it real easy right now. But look at it like this. Let's say you take some of your expenses and you do pay off some bills. You don't take your holdings to pay this off. You do not. You take your expenses. So let's say you take $300 from your income statement. And I'm going to really show this pretty neat. Your revenue for the month is $2,000. Your credit card payment is $300. And the rest of your bills are $1,400. So that's $2,000 minus 3 minus 14, which is a remainder of what? $300? 17? Yep. You have $300. That is what is known as a profit. That is your surplus. That's your monthly profit. $300. Now in this equation, what basically happened, you started off with 13. You still had the 9 at the end of the last balance sheet. Okay, so this is going to be January 31st. This is the income statement as of February 28th. Okay, this does not change until this for the following period is already completed and calculated. Okay, so you have this $300. You still have the 13,000. What happens to this $300 and this $300? Real simple. This $300 comes from here. So now this is 87. This $300 gets added to your assets because there's money left in the bank account, right? So you just put it in the bank account. So now you have plus 300, 13,300. So you're like 13,300, 87. What does this number go up to? Take a guess. Yes. Because you have $300 from here, so that goes up, and you have $300 less of here. So that's 46 plus 87, right, equals 13,300. This is what your budgeting is designed to do. Okay, your budgeting is designed to facilitate this equation at the end of every period. So this is January 31st. You did this for January 31st, and you ended up with this balance sheet equation. Then you do your income statement for February. You ended up at February 28th. You have $300 in surplus. You paid off your credit card down by $300. Now, mind you, I'm just doing this as if it's all principal. I'm not doing any interest. I'm not calculating all that. I understand. Okay. However, now your net worth goes up. You see this? That's the way it works. Now, what's very interesting about personal finance is this. They don't teach this to you. Now, I'm going to go back and do this. Bear with me for a second. I'm not trying to take all your time. I thank you for being with me today. Is this. Imagine if you were 17 years old and you had been taught about that balance sheet equation, the accounting equation. And you were 17 years old, you would have 0 in assets, 0 in liabilities, and 0 in owner's equity. 17 years old. Have nothing, okay? And I'm not including the Jordans, and I'm not including the purses, and nothing like that, the video game systems. I'm not including anything. I'm just saying you start off with nothing. You start work the next month at McDonald's, okay? And your paycheck is $600. Now remember, this goes on the income statement for the month. You bring in $600. You chilling, you having a good time. You spend $300. That gives you a net profit for the month of $300. This is January. You have no liability still because you didn't take on any debt. So this would be sorry about that. Sorry about that. Equals 0. You have 0 liabilities. Now your owner's equity was 0 here, but now it's 300. How about if I just put this here to make it easy? $300. Now your net worth is $300. And every month you have been taught to do this. Imagine where you would be at age 28, 30, 40 if you have been doing a balance sheet every month instead of just doing some type of personal finance budgeting to manage your money in the income statement alone without calculating for the monthly balance sheet or the annual balance sheet. This is the difference. Okay, so when I'm talking about a budget, I'm not talking about a budget just here. I'm talking about a budget to build this net worth, this owner's equity, this capital that you can leverage and utilize to grow more. Because remember, the remaining amount here is already included in the assets. Assets can be cash. Okay, it could be your car, the value, the equity in your car, the equity in your house, some collectibles. Those are assets. Okay, so that's what you're looking to do. With this equation known and applied, you can diligently, deliberately, and have that discipline. Remember, ATD, ATM, TT10. You can leverage the time of your liabilities. Just pay the payments. Just pay the payments, but build your assets because the equation is going to balance out anyway. Okay? So this is how you do it. Remember, balance sheet. Assets equals liabilities plus owner's equity. Income statement, revenue minus expenses. Hopefully you have a surplus, okay? And now you can build your net worth every time period, every month with these two equations that you engage in. One is basically a budget and the other is the balance sheet or the calculation for net worth, okay? And I'm saying net worth because I'm using the words for personal finance when actually I'm using it for accounting, owner's equity or capital, okay? So with this right here, you should be able to really diligently leverage your money and your activities, refine your activities. One more thing, in business and in accounting, there is no such thing as debt elimination. There's such a thing in accounting called debt management. Okay, so accelerating your debt and getting out of the way doesn't do anything. Businesses don't do that. What they do is leverage the credit and time the debt payments. Okay, it's all in the projects and all in the system and process for a business accounting, which is known as managerial accounting. Okay, so when you're looking at it like this, you have the diligence and the wherewithal mostly driven by the knowledge that you have by doing your budget, which is your income statement every month, and then fabricating or calculating your balance sheet to identify where's your assets at, or where's your equity and where are your assets. Okay, where are those things at? You want to build it, you want to grow it, and this is how you do it. Thank you for coming. Professor Wright, learn, grow, teach, be, know, do more. Thank you.